Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
Right, you're watching Stockwatch this week. I'm Zinati Kuma, and joining me to unpack your stock-related questions today via Zoom are Chantal Marx from FNB Wealth and Investments and Kearabilwe Nonyana from Scope Prime Africa. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, lady and gent. Starting off with you, Chantal. One of the questions here is on Boxer, and I actually saw that today. This morning it was down, I think, about 2 or 3%. And I'm wondering if there's anything specific that softened the stock today.
Well, there does seem to be some weakness among the SA Inc. shares today. I see financials under pressure and the retailers broadly being sold off today as well. And I mean, I think it's been a point of contention in the market as to when these stocks will start improving from a rating perspective, because all of them look so much cheaper than they did 6 to 12 months ago. Boxer probably among the group held up relatively well. But unfortunately, I think the sentiment around local retail and the banks, particularly when it comes from an offshore investment perspective, perhaps having soured a little bit, and Boxer just being dragged off along with it.
Well, I mean, the question, Kearabilwe, here is Boxer has done nothing since IPO. Is it a buy or failed IPO? I mean, not that it has done nothing, but it's just that it's not too far off from what the listing price. Yeah, and I'm just wondering at this point, just I guess the drivers of this kind of disappointing movement, where now investors are thinking that it might be a failed IPO, when it probably is not.
Yeah, I wouldn't say it was a failed IPO. Sorry, go ahead.
Kearabilwe.
Yeah, I wouldn't say it's a failed IPO because investing stock. You essentially want to get the best out of every asset that you hold within the stable. And I think for Pick and Pay shareholders and for Pick and Pay themselves, they've really done well because they got the best that they could for a business that was doing very well. As Chantal said, I think that the sector in itself has just been in the doldrums, and my only comment on that is that you can't outgrow a failing economy. And for a very long time, these retailers have done very well for themselves and eking out margin growth, especially at the top end of the quality, which is like the ShopRite as well as the Boxes. But at some point in time, the economy to grow market to start to re-rate some of these shares, including the banks, as Chantal has said.
Well, actually, just on that retail sector, I want to go into Spar, because I was reading a story in the news bulletin that Spar is now expanding into pet, and I was actually having a retail conversation about these retailers going into adjacent revenue streams. Is Spar just really committed at this point to growing after what seemed like a period of failure, Chantal?
Yeah, I'm getting the impression that management team is exceptionally focused right now, and they're very much focused on the South African and the Irish market, where they have a very decent footprint. In South Africa, in particular, I think that they've fallen behind somewhat. They haven't benefited as much by the weakness that we've seen in the Pick and Pay stable as the ShopRite group has, and they're realizing now that this home market still has a lot of opportunity for them. I've been seeing the management team really up their PR as well, which tells me that they feel like they have a good story to tell. So I'm also taking notice of Spar right now. It's been a notable outperformer. We haven't seen a major re-rating after the exit from Switzerland was announced. So I think a really interesting one to keep an eye on in this space.
Yeah, really, yeah. Everyone's PR is top tier at this point. Of course, we know 60-60 Pick and Pay. You see Pick and Pay at the airport, in rugby. that now, Spar. And I'm wondering, Kearabilwe, because for a long time then people were kind of putting Pick and Pay and Spar in the same box. Does it look like there's tight competition now between Spar and Pick and Pay to see who is actually going to rise up from the ashes that they were in?
To be perfectly honest, I mean, I'm just looking at just the shopping centers around where I live and the amount of Pick and Pays which have closed down in part of management exit from many places. And to be perfectly honest, the only person coming to replace them is not far but checkers. And it really shows the different stories that the not really had in the retail space. And I think right now, Pick and Pay for me, the only jewel in that crown is Boxer, and truly speaking, the rest of the other business still trying to start, and it's take a lot of time. The management with all the SAP in a couple of years ago, which they had to write off about it, and then this exit, which is also not have been a quite costly exit. So I think even if they see growth within Ireland and South Africa, it's still takes a management and execution risk for it to be seen in results going forward. So right now, if you are entering into the space, I think ShopRite would be the ideal place to be.
Okay, all right, I hear you. Yeah, people constantly flocking to ShopRite as bees, and ShopRite being the honey. Let's get into Naspers. There's a question on Naspers that I am looking for, but it's basically on the stock split that is coming up, Chantal, I think in the first week of October. I think the viewer was actually asking how that will affect the value of the stock. Chantal?
So it shouldn't affect the overall market value of Naspers. The overall market cap will remain exactly the same. What happens is each share is split into 5, right? And the share price will reduce by 80%. So it'll be a fifth of what it was. But if you multiply that new share price with the new number of shares in issue, the market cap will be exactly the same. So then you ask yourself, why does a company do something like that? Well, the biggest reason is that the share price becomes too high. So to buy one share, you need a lot of money, and that essentially closes the door for a lot of retail investors. So this just makes it easier for retail investors to also benefit from the potential future growth in Naspers. It's actually a really nice corporate responsibility thing to do as well. I really am a massive fan of the humble stock split, and I think it'll just make it a lot easier for investors to get involved.
Well, I mean, this is interesting because obviously now from the first week of October, retail investors with less money can get into the stock. Just looking also because that share price has ran, and I'm just thinking, Kearabilwe, then on that day or on that week, would it be a good time to go in? Is Naspers one of those that as high as it's gone, as much as it's rallied, you can still get in because the growth runway still has more juice?
I mean, quantity in terms of value, I said it's going to remain the same. The P's are going to be the same. Everything's going to remain exactly the same. What really for me is the drive of Naspers and still remains Tencent. I mean, the management has a good story to tell on the other businesses and them getting the profitable. But at the end of the day, when you're taking Naspers, you're taking a bit and essentially looking at how far has Tencent really gone, and you've seen that the AI drivers in that stock are coming to fruition. The cash generative properties of Tencent are still on the up, and we're seeing the Chinese starting to lessen their grip on the gaming market and them introducing more games and having more screen time. And I think to be perfectly honest, could we see a re-rating in the? I mean, would you have ever thought that Naspers would be sitting at almost 6,000 rand? And that's the question you have to ask yourself. This stock has done so well and as well for investors on the SA market, that essentially it continues to have that favor in the hearts of SA investors just purely because you can't get anything like it on the African continent.
All right. Well, before we get to the break, Chantal, I want to come to you with the Brait/Premier. So with Brait, well, yeah, this is specifically for Brait, actually. With Brait owning a big stake in Premier and Premier moving up 15%, surely it must be positive for Brait. Yeah, Brait is one that we haven't spoken about a lot. And of course, there's just like corporate action also there. And there was also that recapitalization that they did, and investors being disappointed that the stock has not done anything. So what's your take on Brait, particularly with the linkage that it has with Premier?
Yeah, I mean, so Brait is essentially in a process of winding up the vehicle, right? But for that to happen, a few things need to happen first. They need to get their debt under control and probably start paying off a fair chunk of that, or kind of get a way around placing some of that debt within their portfolio companies. They need to list Virgin Active. And you could argue that it was definitely not the right time post-COVID-19 to list Virgin Active. Things are starting to look better there, but they've actually now more recently put a lot of capital expenditure into refurbishing a lot of those gyms. I think that they are trying to get that business ready for an IPO. So that needs to happen. And then they need to figure out what are they going to do with this new look thing. So this is the retailer in the UK. It's been a massive problem for them. It drove most of the issues within the Brait stable to begin with. Premier is easy. They can unbundle that to shareholders. And the nice thing about Premier within the Brait stable currently is it's generating high cash flows, it's paying dividends, and it gives them a way to fix their balance sheets and to pay down debt. The IPO the listing also helped Brait in that regard to begin with, and I think perhaps they can actually sell some of that some of that Premier stake as well in order to raise capital. So there's a lot that they're busy doing. My caution is, and they're trading at a deep discount to net asset value. The caution here is just it's going to take a while for them to get all of this done, and now you're stuck in Brait. And you don't know what they're going to do with the debt. And you don't know if they're going to be successful. There's a lot of execution risk in this plan. So there's an opportunity cost there in terms of what you do with your capital. But I think certainly if you're willing to hold on for 5 years, you're going to get that upside, right? But you just need to decide if it's enough.
Yeah, new look is a sad look.
It's an old look.
Exactly. Kearabilwe, particularly with Premier, because they did come out with numbers this week, and I'm wondering if this is a safe space to be in.
It's a great place to be. Now, I'm never a liker of food producers, but I'm a liker of their brands. And what I mean by that is the first lesson I got in equity analysis, especially in food producers, is aisle space. And what they mean is if you're not top of the aisle, meaning that you're not at eye level for consumers to see your brand, you essentially you're playing second fiddle. And Premier's brands have stood the test of time. I mean, it's one of the oldest brands in South Africa. But I mean, looking at when they listed and where the share price is right now, it's almost up 200%.
Wow.
And are you going to be really getting the true value that you're really going to be getting out of Premier Food Group right now? Still strong cash flow generator, got really a great margin securer. I really like the business, but I always find that it's too fully priced whenever I want to go in.
Yeah, Shem, no, I hear you. Well, actually, just talking about the food producers, Kearabilwe says he's not really too much of a fan, but he can get Premier. There's also potential corporate action, Chantal, on Lipstar. We did see investors reacting earlier on in the week. And also AVI also came out with numbers, if I'm not mistaken, and RFG as well. Yeah, what do you think of that food sector, and particularly with this kind of corporate action that we could be seeing? And yeah, we've been hearing murmurs of that for quite a few years.
Yeah, I mean, these stocks have just been exceptionally cheap. So you almost have the haves and the have-nots within the food producer space. So the haves are Tiger Brands, AVI, and probably Pioneer to a certain extent. The ratings are decent, earnings visibility is good, management is well respected, and they have scale, right? And then you have the have-nots, the smaller ones, RCL, RFG, Lipstar, and they are just way, way, way too cheap. All of these companies have very decent growth runway. I think Lipstar in particular is such an interesting one because there's a self-help story that's playing out quite beautifully at the moment. They're doing all the right things strategically. And I think if investors are just patient, you'll be able to get everything you want from that stock over the next 2 to 3 years without having to take a takeout offer right now. I think it's super opportunistic. I don't know what that price is going to be, but if it's not 100% upside or 150% upside, I think it's an opportunistic type bid that's going to come through. And I'm not surprised because the exact same thing happened to Pioneer. And yeah, I'm just, I'm not shocked, but I actually hope that we can keep it as a listed entity and enjoy the benefits from that turnaround.
Okay. Well, let's go into mining. Very interesting question, funny. Would your panel advise their own aging, decrepit grandfather to sell Glencore and buy Anglo? Would you be selling Glencore to buy Anglo? Of course, also Anglo being the subject of corporate action, Kearabilwe?
Yeah, I mean, you're going into two different commodity mixes within Glencore. And with Glencore, you're still getting the trading business. You know, one thing Glencore is exposed to is coal and thermal coal. And essentially why you're seeing it lag behind some of its competitors because it has exposure to coal. So that question is a bit of a difficult one because it's where do you see coal prices going in the near future? And coal is but a litmus test on how well the global economy is going to be doing and essentially how much we're going to be generating in terms of economic growth. Whereas I think with Anglo, this new acquisition is going to be more of a copper play. And the forecast your corporate deficits in 2025. I'm guessing if you anticipate that you'll be alive in 10 years, more is quite an essential commodity in the AI and the fourth industrial revolution. So would I be selling Glencore to buy Anglo? Probably yes.
Okay. Yeah. I mean, a lot of people, actually, I mean, just looking at the stock, it seems that's actually maybe the story here. Chantal, how would you be looking at this trade?
I'd actually sell half my Glencore and buy Anglo and still keep the other half. So I think that there's benefit in diversification. Anglo's is becoming very targeted now on copper and iron ore, and Glencore you do get that different commodity mix, and then the marketing business, which does well regardless of what happens to commodity prices. So it's a little bit more defensive, I think.
Okay. Well, let's get into property. We have Nepi Rockcastle. We don't actually talk about this one a lot, and I feel like it is a good performer. Looking at Nepi Rockcastle's exposure to Europe, lower loan to value ratio of around 32%, high dividend yield, and rand hedged investment. Would this be a great investment case? Let's actually just start off with that. And Kearabilwe, I mean, we've seen across the board the property stocks that are exposed to Europe actually doing very well. Would Nepi Rockcastle be on your radar?
I'm not a fan of REITs, but I think they're becoming quite interesting in terms of the yields currently. And you've seen it in terms of the results which are coming out with point attack and high prop. I think exposed to Europe, and it has quite an interesting. It has competitors which are locally listed. So it is an entry into Europe, into that space. But currently, I think it is the beginning of the well, because we're starting to see a lot of inflows in the bond market. The yields are no longer as attractive as they used to be, and the yield currently on REITs right now are almost comparable. So I think you will start to see a re-rating in the REITs locally. I think Napier is a good one if you want exposure into Europe.
Well, as you're referencing the other locally listed REITs, Kearabilwe, the second part of that question is, would Napier Rockcastle be a great investment case comparing it to a more diversified growth point, which has more SA assets? Which would you go for, Chantal?
Yeah, so I mean, Growth Point, you are essentially buying SA. They've got some Australian exposure, and Growth Point is the biggest property company in South Africa. It's very, very broad. You get exposure to everything from student housing to hospitals to the V&A waterfront, right? So you're essentially buying SA property when you're buying Growth Point. When you're buying Napier Rockcastle, you're buying Eastern European property. And Eastern European property fundamentals are really positive because they're in a high growth area of the world. So Eastern Europe is growing exceptionally strong. We're talking about 6-7% GDP growth rates, and you are going to struggle to find the same sort of distribution growth locally. That said, local property fundamentals have improved greatly off a very depressed base. We're seeing valuations moving in the right direction. We're seeing rental reversions moving in the right direction. So I am quite positive on being in both of those spaces right now. So again, it feels like a cop-out because I said exactly the same thing about Anglos and Glencore, but I'd probably own both.
Okay, very interesting. Yeah, I mean, if you can do both, do both. All right, let's go into, before we get to your stock picks, Chantal, I'm going to give you Cal Group and Kearabilwe Omnia. What's your view on Omnia, Kearabilwe?
It's chemicals, and what we've seen in chemicals is that any company that's been in chemicals has not done well. I mean, case in point, I'd look at Sasol as well. So, I mean, chemical prices are very depressed. Essentially, you would need a re-rating in chemical prices for some of these stocks to start doing well. And the thing about Omnia is that they've kind of streamlined their business and looked at what essentially is going forward. I mean, right now you are still at the beginning of that rethink, but currently, in my opinion, I wouldn't touch chemicals with a 10-foot pole. I'd want to see chemical prices start to re-rate such that I can start looking at any chemical business at present.
Yeah, and actually just looking at that graph, the picture has not looked pretty since July. What about Cal Group? Chantal, the viewer says, I bought it in February this year and it is continuously going down. Should I cut my losses or hang in there? This is what the previous COP Agri.
Yes, Kaap Agri, the corporatie. But it's no longer just the corporatie. So you still have Agri-Mart and that side of the business, the agricultural side of the business, which I think I would be quite positive about given the agricultural conditions in South Africa and the growth of that sector. But they also have a very large portion of their business now in fuel retail and forecourts. So you have to take a view on the fuel price, which has more recently been under pressure, and oil prices, which have been under pressure, the rand, which has been quite strong, and then on fuel sales volumes and forecourt sales volumes. So I can see an argument for economic growth tailwinds driving more demand for fuel and forecourt sales. But I think fundamentally your price is going to be under pressure in terms of the fuel that you sell. So the margins stay the same, right? But the revenue comes under pressure. So that's probably what's being reflected in the share price and the share price movement from the start of the year. That said, the stock's trading on 6 times PE, so it's cheap as chips. I wouldn't necessarily sell it right now because these things change. It's cyclical, right? So, and that agricultural side of things, I think, could prop it up quite well.
Yeah, all right. Well, let's get to your stock picks for today. Kearabilwe, where are you finding opportunity? I guess not a lot of time, maybe 30 seconds each for this one. Kearabilwe.
Yeah, Skyler Corp listed in the US. Essentially, it's in medical equipment. I think anything that has to do with medical has a lot of regulatory hurdles, and you're seeing regulators trying to bring down prices, but not in medical equipment and innovation there. I think they are really heavy in robotics, and essentially it's trading at 50 PE, which is but Child has a neutral rating on it. $470 and is currently trading about $372.
Well, actually, that's a good one, Kearabilwe, because we did have a question here on the medical equipment sector. Which companies would you recommend that are trading at or below fair value? So to the viewer, there is your answer. Striker Corp. Chantal, where are you finding value today?
I'm finding value in South Africa. You could probably take your pick at this point: banks, retailers, industrials. I'm going for construction. So Raubex is where I see value. The share price has come under a lot of pressure over the last few months, unfairly so. Really good order book growth momentum, lots of opportunities coming through from Sunral's perspective, as well as tender activity generally being quite robust, both from an infrastructure perspective for government as well as from the private sector. Even though it doesn't, we're not a construction site yet.
Yeah.
When we become a construction site in South Africa, Raubex will be a key beneficiary, a bit of a last man standing type narrative playing out.
Okay. Well, thank you so much for your time, lady and gent. Really appreciate your analysis today. Thanks to my guests, Kearabilwe Nonyana from Scope Prime Africa and Chantal Marx from FNB Wealth and Investments. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and do keep sending your questions. For now, that is all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.